The second inventory adjustment that we want to have a look at is stationery or consumable stores on hand. Now, just in terms of terminology, consumable stores refers to those goods that are typically being used in the business. For example, a hairdresser may have shampoo or other materials, hairspray, etc. that is being used in the business, and we call that consumables because they are consumed or used in the business. Another entity may have packing materials, all sorts of different consumables for the different businesses. And the adjustment that we're going to look at is consumable stores on hand. So a question will typically state something like stationery on hand amounted to 300 Rand, or consumable stores on hand amounted to 300 Rand. And we need to interpret that. So we will have, as with all adjustments, a current picture and a true picture. So let's see. Current picture and the true picture of expenses and assets. Now, our current picture may reflect in the trial balance that, so my trial balance here may reflect that I've got an expense for stationery of 1.5 thousand Rand. And that is an expense. So my expenses may be, let's say this represents 1,500 Rand. So there we go, 1,500 Rand in expenses. My assets in the same picture is going to be 0. Alright, so expenses 1,500, assets 0. Let's maybe just use a different color for my assets. Right, so there we go. We've got expenses at 1,500 and assets at 0. The true picture may be that when we get to the end of the year, 31st of December, we may go and we do a stock count and we find again, so let's just go at the year end, the true picture. We go to our little storeroom again and we find, we do our stock count. There's my list and I count all the stationery and I find that actually there is 300 Rands worth of stationery. There's my pens and etc. 300 Rand that is still in the storeroom. Alright, so what that means is I actually still own some assets. So if we look at the assets versus the expenses, we will see that my assets is actually around about 300 Rand. So there we go. So, and my expenses is now going to be slightly less. Alright, it's going to be 1,200 Rand. Right, so the adjustment is going to simply be the difference between the true picture and the current picture. So initially, when we did our transactions during the year and we purchased the stationery, the full 1,500 was recorded against expenses. Because when you buy the stationery, you're going to assume that all of the stationery will be fully consumed or used during the year. And if something is fully consumed or used, there's no more benefit that you can get from it. So it needs to be an expense. So originally when you buy the stationery or consumable stores, if that was the case, you'd put everything against an expense. However, when you get to the year end and you look at the true picture, you'll find that there is actually some of this stationery that is still in the storeroom. So it's not yet been used. So some of the stationery is, we can say it's unused. So if it is unused, we need to record that as an asset. So the shortcut here is, if it's used, it needs to be an expense. If it's unused, it needs to be an asset. And that's pretty much like that for for all of my assets and expenses. So in this case, to get from the 1,500 expense to the 1,200, I need to reduce my expense. So the adjustment is going to be adjustment here. My expense needs to decrease by 300 Rand, and my asset needs to increase by 300 Rand. So the expense that is specifically being decreased here is called stationery, and the asset that is being increased here we are going to call stationery on hand. So just by adding these two words, this account is going to be an asset. So stationery by itself is an expense, stationery on hand is going to be the asset account. Right, so to decrease my expense, stationery, that click tells me I have to debit expenses if they increased, but here we don't have an increase, we've got a decrease. So in this case we're going to pass a credit to the stationery account, and then we know that the other account is going to be a debit, but let's check that. That click says debit expenses and assets if they increased, which is what happened here. So I'm going to debit the stationery on hand, and that is my typical transaction with consumable or stationery on hand. So you'll remember with the trading stock deficit, we moved money out of the asset to an expense. With the stationery on hand, everything originally goes into the expense. With the trading stock, everything originally went into the trading stock account and we had to move it out to an expense. But here with stationery and consumable stores on hand, when we do the transaction originally, everything is going to be assumed to be fully used or consumed, and we're going to record an expense. And thus when we do the adjustment, we're going to take 300 Rand out of the expense and we're going to move it to the asset. So this 300 Rand here was moved to the asset account, and that was my adjustment right here. Good.